In this video, we're going to look at different sales transactions and how they would be handled under both the periodic and perpetual inventory systems, so you can see the similarities and differences. And we're going to use part 2 of exercise 4.7 and 4.20 as an example. So we'll jump back into our scenario with Sydney and Troy. Keep in mind, with our first video series, we recorded the entries of the buyer, which was Sydney Retailing. In this video, we're going to focus on the sales entries by the seller, Troy Wholesalers. So on May 11th, if you recall, Troy is going to sell $50,000, which is the selling price of merchandise on the account. The merchandise had a cost to Troy of $30,000, which is something that we ignored on the buyer side, but now we have to reflect that. For the sale, if you recall, the terms are $310 net $90. On the buyer side, which was Sydney, we called that a purchase discount. But on the seller side, which is Troy's side, we call it a sales discount. Very similar to Sydney's side. In this specific case, if the customer, which is Sydney, pays within 10 days, then that 3% discount can be taken. If not, the total amount of $50,000 is due within 90 days. Just the same as the purchase discount on the buyer side, the purpose of a sales discount is to encourage early payment. Whenever a sale is made under the perpetual inventory system, keep in mind the seller, which in this instance is going to be Troy, is going to make two separate entries. One of those entries is going to be at retail, or the selling price, and one of those entries is going to be at cost. The retail entry is going to include a debit to accounts receivable or cash if it is a cash sale, which is not in this scenario, and it's also going to include a credit to sales. The first entry records the sales price charged to the customer. In our particular example, this entry is going to include a debit or increase to accounts receivable for $50,000 and a credit or increase to sales also for $50,000. This entry is the same no matter if you're a merchandise company that resells inventory and account, like Troy is, or you're a service company like an attorney or someone that has a cleaning service, etc. Second entry, however, is going to be made to record the cost of the merchandise when it was originally purchased by the seller. It removes the inventory from the balance sheet and matches its cost or expense against the revenue earned and recorded in our first entry here. The cost entry is going to include a debit to cost of goods sold and a credit to merchandise inventory. A service company, like we've typically been recording in the past, doesn't have the second entry. In our example, we've got a debit to cost of goods sold, increasing it by $30,000, and that matches it against the $50,000 sales revenue we record in our first entry. In the second entry, we also have a credit or decrease to merchandise inventory for $30,000 to remove the inventory from the balance sheet. I'll note that at the time of the sale, again, similar to what we did on Sydney Retailing's, the buyer side, we completely ignore the 3% discount. We have to wait until we determine whether or not Sydney really does pay within the 10-day window, and that's when we will record it if they do. I also want to show you what the merchandise inventory and cost of goods sold accounts look like after we post these entries. I will note that I don't show you the T accounts for accounts receivable and sales. I instead just focus on merchandise inventory and cost of goods sold and the effect of that second entry. Assuming our merchandise inventory account balance of $45,120 carries over from part 1 in my earlier video, you will see that the merchandise inventory balance of $15,120, that's a resulting balance, has been updated for the amount of inventory remaining on hand. We started with our carry forward balance of $45,120. We credited or removed $30,000 worth of inventory from our shelves, and we show a resulting balance of $15,120. You'll also see that cost of goods sold has an up-to-date balance of the cost of inventory that Troy sold to its customers. So we are achieving that perpetual balances in these two accounts. Since the periodic inventory system doesn't keep this up-to-date record of merchandise inventory, whether it's a purchase, sale, or another transaction, how do you think we're going to record this sales transaction? What are the similarities and differences from the perpetual inventory system? If we think about it, it makes sense that we're going to still need to record the sale on account by debiting accounts receivable and crediting sales, because we still have to record the revenue the company has earned and also the outstanding amount due from the customer. So logically, it seems like the first entry isn't going to change. On the other hand, what about our second entry here? Under the periodic inventory system, we just simply eliminate that second entry. First entry is exactly the same. We just eliminate the second entry because we're not recording the cost of goods sold and we're not adjusting the inventory balance. The merchandise inventory account keeps the same balance from our last count, usually at the end of the last year. It remains at that same balance until we perform a new count at the end of the period. Also, in addition, cost of goods sold has to be calculated at the end of the period, which I already demonstrated in an earlier video. You can see the comparison of the merchandise inventory account and cost of goods sold account between the perpetual and periodic methods. I'm assuming here that Troy just started business on May the 1st, which is why I have a 0 beginning balance of merchandise inventory at the start of the month. If this had not been the first month of the business, the ending balance from the prior period, so April's ending balance, would have carried forward in our merchandise inventory account. I will also note that if this had been an FOB destination terms, if that had been the shipping terms versus shipping point, we would have had some differences. FOB destination means that the seller pays for freight since it's responsible for the shipment until it arrives at the customer's destination. In that instance, if that had occurred, it would have been considered a selling expense to the seller. So they would have debited some type of an expense account, something like delivery expense or transportation out or freight out. That's not transportation in or freight in. Transportation out or freight out. The credit really would have depended upon, are we paying cash immediately? If so, we would have credited cash. If there were terms, maybe they gave us 10 days to pay it off, we would have credited accounts payable. I realize that doesn't come into play in this particular problem, but it's something that you need to know going into our exam. So let's keep moving forward and continue to record entries from Troy, the seller side. On May the 12th, Troy is going to accept part of the merchandise sold on May 11th as a return for full credit of $4,000. That was the original selling price. It's going to return those to its merchandise inventory, so it's going to be able to throw it back on their shelves. Keep in mind that the original cost of this merchandise to Troy was $2,400. Under the perpetual inventory system, which is going to be our exercise 4.7, a return of merchandise is going to record 2 entries, and it's going to be similar to our sales entry, where we're going to have one at retail, or the selling price, and one at cost. The retail entry is going to include a debit or increase to sales returns and allowances, and a credit or decrease to accounts receivable for that selling price of $4,000. Ultimately, this entry is a reversal of that entry that we made when the sale occurred. But instead of debiting the sales account, we debit a new contra. I know you're groaning. I have to learn another contra account. We debit a new contra revenue account, the sales returns and allowances account. Sales returns and allowances has a normal debit balance, and it's subtracted from the sales account to arrive at net sales on the income statement. Companies, and we're not just trying to make this more complicated, they use separate contra accounts like this because they want to have separate balances for the amounts actually invoiced to customers that would show up as a credit in sales. On the other hand, what concessions they're giving to customers for returns and allowances, they want that to show up in a separate sales returns and allowances account. If they mingled it together, it'd be harder to put a dollar figure on the effect of actual defective product. tax. So we also have a second entry here, the cost entry, that in essence it's reversing the original entry that we made at the time of the sale. It includes a debit or increase to merchandise inventory, which seems logical because we're throwing the merchandise back on the shelf, and a credit or decrease to cost of goods sold for $2,400, which is the cost of the returned merchandise. So we're crediting this expense account because these goods are no longer matched against revenue to the customer. It's product that we can resell. I will note things would have changed a little bit if this had been allowance versus a return. We would have just completely gotten rid of the second entry because there's no merchandise that was thrown back on the shelf. Also, if the product had been defective, something that Troy couldn't have used, we would have also eliminated that second entry. Things get a little bit more tricky if we end up receiving back defective goods which we can reuse but have to be repaired. In that instance, then Troy would have had to approximate what are these goods worth. For example, they might have said, hey, I know that they originally cost me $2,400, but I'm going to have to pay $200 to repair them. $2,400 minus $200 is $2,200. That's the dollar amount that they would have recorded the second entry or debit to merchandise inventory and cost of goods sold for. So going back to our original scenario, let's look at merchandise inventory and cost of goods sold. After posting the second entry, merchandise inventory account has increased by $2,400 to include the inventory that's now back on the shelves and can be resold. The $27,600 balance of cost of goods sold reflects the fact that there's a decrease in cost due product being returned. It's available for another sale. So very similar to what we did on the sales side, on the return side for Troy on the periodic inventory system, we only record the revenue effect of the first entry. We don't show the cost effect of the second entry because we're not showing inventory coming in and out of the system on a transaction by transaction basis. So what happens when Troy receives Sydney's payment on May the 20th? Very quickly, since I already went through these calculations on the purchase side, recall the sale was for $50,000, but Troy accepted a return at $4,000, which means the total amount due in accounts receivable is $46,000. On the other hand, Sydney is paying within that 10-day window. The original sale was May 11th. They're paying on May 20th, so they can take 3% times $46,000. Is a discount of $1,380. Subtract that from the $46,000 due in accounts receivable. It means the actual check amount or amount they're going to pay is going to be $44,620 because they're taking advantage of the 3% discount. So again, what do things look like on Troy's side when they're receiving payment? Well, it doesn't matter if we're talking about the periodic perpetual inventory system. Some good news, the entry is exactly the same. We're going to debit or increase cash for $44,620, which is the actual amount due of $46,000 minus the 3% discount. We're also going to debit sales discounts. It's going to be a debit for $1,380. That's the discount amount. And on the other hand, we're going to have a credit or decrease to accounts receivable for the total amount due of $46,000. Like sales returns and allowances, sales discounts is another contra revenue account. So it's related to sales, but has opposite the normal balance. It has a normal debit balance, and it's ultimately subtracted from sales on the income statement to arrive at net sales. So let's take a look. After these entries are posted, the balance in accounts receivable is 0, indicating everything's been paid in full as far as Troy is concerned. If we had made a typical mistake and had credited accounts receivable for $45,620 instead of $46,000, we would have had a remaining balance in accounts receivable $1,380 in error. It would have made it look like that Sydney still owes Troy some funds, even though they considered this to be paid in full. A quick note, what if this payment had been made outside of the 10-day window? Let's say that Sydney had paid on May 22nd instead of May 20th. We would have still had a credit to accounts receivable $46,000. eliminated sales discount, and the debit to cash would have been the full amount, $46,000.